Okay, Patrick, it's time for This Week in Trading History. What do you got for us?
We have to go to 40 years ago, Kev, when Paul Volcker was actually, he took the office as the Fed chair.
You know what I like best about Paul Volcker? When those pictures of way back when? He's got
Cigar.
a big cigar. Like
Can you imagine trying to pull that off today? Can you imagine, like, Powell walking out into a FOMC conference and he's got a big-ass stogie and he's got smoke just clouding his face. He's like,
he'd probably be vaping these days.
We're cutting
though.
interest rates. Got it? It's like a mafia. It's like a mafia scene right out of, like, Godfather or something, isn't it?
I don't know if they were big cigar smokers, but
but it feels like that. I'm not forget that they were or weren't, but like it feels like that. It's like a mafia scene. Anyway, but Paul Volcker, right? So he took office he takes the office of Fed chair on August 6th of 1979. And by the way, he was a giant, wasn't he? Like, I think, was he like 6'6" or something?
Yeah, he's tall. Like, there's no doubt about it.
Like, it was amazing. They showed these pictures of him walking up the stairs of the Fed, and like he's got his assistants beside him, and he's like an entire head higher than everybody else. He was huge. But anyway, so he was the one who did some pretty crazy monetary policy, right? And so what I wanted to do was just go back and actually give everyone a quick kind of rundown of what was going on in the 70s and just like what he had to contend with when he came in, right? Because so there were two central bankers before him, right? The majority of the 1970s was Arthur Burns. Now, you've mentioned, but this is interesting because isn't it amazing how the media generally doesn't go much farther back than Volcker nowadays?
Yeah, a lot of people wouldn't even be able to name those two central bankers. I know Arthur Burns because he was the guy that Lyndon Johnson, or was it? Yeah, I think it was Lyndon Johnson, put up and strangled, telling him to go that he was going to cut rates.
Isn't that amazing? Can you imagine today Powell grabbing... sorry, not Powell, but Trump grabbing Powell by the throat and saying, you're going to cut rates?
Although
that's the way shit rolled 40 years ago, dude.
But, I know, but it's kind of doing that today. He's just doing it on Twitter. He's doing the social media equivalent. And interestingly enough, Patrick, we're taping this on Friday. Today I heard, Trump saying to Powell that, not to Powell, but to the market in one of his scrums, that he thought that they should lower rates 100 basis points. He's doing the equivalent. He's doing the social media equivalent of what...
Of giving him a throat grab.
A throat grab.
But okay, but after Burns, very quickly, was William Miller, right? He was only for 2 years, from 78 to 79. And Volcker took over for him. And so very few people talk about them, but it was the inflation of the 70s, right? And it wasn't hyperinflation. Hyperinflation, you have to. What is the official definition of hyperinflation? Something like 50% in a year or something.
I don't know.
It's some number, but we never saw hyperinflation in the U.S. It was just very high. It was high inflation.
Yeah.
We saw very high inflation. And so that inflation really kicked in the 70s, particularly once the gold standard was removed and we started this new fiat currency era. But we saw inflation rates in the mid-70s hit about 12%, and then again going into 1980 hitting 14+% inflation rates. Can you imagine that happening today?
Yeah, there's no way because that's never going to happen again, Patrick.
Well, okay, maybe in your fantasy land, we're going to bring the other Wisconsin beer, the Fantasy Factory, out for your magic unicorn inflation ride again.
That's right.
But nonetheless, inflation ran, and it was a very oil shock driven inflation back then, was it not? I think
it wasn't, but it was also, don't forget, it was the Vietnam War. They were spending on the war and not raising taxes enough to pay for it. So we had a massive amount of fiscal spending, and that wasn't getting taken out of the system. And
exactly.
And that's what we kind of and people were shocked. And the interesting thing about it was that not only did you get that spending, but you had interest rates that were kept low. So real rates were even lower. So it might look like, rates were high, but, don't forget during Miller's time, they were pegged at 6 or something, and inflation's running 12. At that point,
crazy.
you have Yeah, you have negative 6% real rates.
Right. And so you have inflation literally going, the rate of change to the upside would make a guy like Keith McCullough go gaga when he's looking at rate of change shit. Like you basically have it going parabolic to the upside through that 78, 79 period, ending his term as central banker very quickly. And then you bring in the big guns, right? Volcker
Yeah.
comes in. And what does he do? He hammers interest rates, right?
Cranks them. Like he cranks them through the roof.
Cranks the interest rates, right? Actually, we'll go about these Dow charts, but let's look at these interest rates. So, yeah, so going into 1980, as soon as he takes office, you essentially have interest rates go from being somewhere around 10%. He cranks them to 13% and then up to 17, 18%.
And then you know what the funny thing is? They go back down to 9. And he's then forced to raise them again in 81, and he raises
hits
them
at 19%.
Like, think about that volatility.
You know what
in
was
the
crazy?
Euro
It was
dollars.
just when they put the sanctions onto Russia and the Russian central bank jumped interest rates to like 17%, I nearly fell out of my seat. And then they go back here and it's like, no, it happened in the U.S. too, right? Like,
For
it's
sure.
crazy, right? Like, just seeing, what interest rates were doing in responses. Volcker basically cranked rates to these astronomical levels.
And
to-
what
to- to
I'm going to
fight
interrupt you
inflation.
there, Patrick, for a second, because what was most interesting about that time is even though he was cranking rates, nobody believed that inflation was ever going to be tamed. It was
Really?
almost the exact opposite of what we have now.
Yeah.
Back then, he was cranking rates, and everyone said, "Nope, you can't. It won't work. There's no way. It's not going to create. It's not going to stop inflation." And it was shocking how little the market believed that he was going to be able to affect things.
Yeah.
And you had guys like Henry Kaufman, who was Dr. Doom, thought that inflation was going to continue forever and there was no way they were going to stop it. And for the next decade, he kept calling for that inflation to go back to those levels, and it didn't.
And he was wrong.
He was wrong.
But you know what's amazing was that this Volcker and his shoot up of interest rates represented, in my mind, the reset of the financial system that allowed the next 40-year bull market to occur. Whether in equities, whether in bonds, everything happened because of this moment. Right? Like when you're starting interest rates at 19%, you're creating a perfect environment for one of the greatest bull markets of all time, right? And if you're in the 1980s and you're Berkshire Hathaway and you're a value investor and you load or Templeton and you basically start buying stocks when they're at historically low PE ratios, you basically started the beginning of what was one of the most epic 40-year bull markets of all time, isn't it?
Yeah, because they were priced for death. And as we talked
It was
about,
priced for death.
Right,
And no, so let's give all our millennials a quick lesson here on stock markets and inflation-adjusted stock markets, because when people look at a standard nominal price chart of the Dow Jones, they see from 1965 to 1982, this era of 17 plus years, where on a chart it appears that the Dow Jones just stayed flat. It was range bound. You know,
right, it couldn't get through 1,000 basically.
It couldn't. Everyone perceives that it just can't get through 1,000. It tested at 1,000 in 1966,
1, 2, 3, 4, 5
in
times.
1969, in 1973, in 1977, and again in 1981. Like you basically have the Dow Jones hitting 1,000 on 5 occasions and never being able to break. And so everyone's like, oh, well, the market's just stuck in a range. But that is not really what your return was it, Kev?
No, in real terms, it was a lot lower. Because don't forget, during this period, we had inflation running 14%.
Exactly. So when you go and look at a chart, what I'm showing here, and you look at your inflation-adjusted returns of the Dow Jones, we went from the equivalent of 8,000 down to 2,000. It was like a 70+% wipeout of the equity purchasing value of your money. It was one of the great bear markets. I mean, you have to go back to 1929 to see a wipeout of equity to this magnitude, right?
Yeah, it was in real terms. It was devastating.
The big difference is like if you look at 2008, that was just like a 18-month hiccup, right? Like you can go and you go over a 3 to 5 year time period. Stocks recovered so quickly that most people didn't see the difference if you just had a long enough time horizon. But this is almost a 2-decade bleed out.
Yeah, think about trying to invest in stocks for the long haul. As a, you know,
For
can
two
enter
decades of just
yeah. Think about entering the
hammered.
workforce in 1966, and think about how much conviction you're going to have for the next, you know, it's not
20
quite 2 decades,
20 years
15 years. Every year for 15 years it goes down. Feels like interest rates today.
But see, that's the beautiful thing about nominal prices is that you see that nominal number. The majority of people can be fooled by that because inflation is that hidden thief, right? That you don't see in a nominal price.
Right, but you know, in
you
terms
feel it
of
in your purchasing power.
for sure. So why
Right,
would you
like-
be investing in stocks when that's happened? 'Cause
Anyway.
don't forget, during this whole time, you could buy a bond that was yielding 10%.
Yeah.
There was at least, you know what, it was still getting
Oh.
inflated away, but the reality
Well,
is
this
at least
is
you were earning
where
something.
back then you buy those long dated bonds. You know, I think a long dated bond it didn't have as like there was huge disparity in the yield curve, right? Because while you on short term money you could get 19%, the long bond didn't trade up to 19.
I think the
What
long
it
bond went to
was like
16 or something. There was a 16,
like 12
I
or
think.
13. Was there 16? I thought
I
it was
think there
12,
was, or
13%.
maybe it was Canada because I know our rates were higher. We had more problems, but I think there was a 16% like highest coupon 30-year. I think there was something like that. There was some famous issue that was done at the height of the bear market, and it had a huge monster coupon, and it came out, and it was issued at $100 and never saw that again until it expired.
Yeah. Well,
or till it
you know what?
matured.
I'm going to stick my neck out, and maybe you can call me an idiot for this. Go ahead and call me. But everyone likes to give Reagan all the credit for all of his fiscal and tax policies and all the other stuff Reagan did. But I honestly think that all the bulls out there should be thanking Volcker for what happened in the 80s and 90s, because I think that by him slamming down inflation and bringing the whole market in, created the environment from which that bull market could have happened. I think he's more responsible than Reagan is. You call me an idiot for that or what? Or you agree?
So one of the things, though, Patrick, about that argument is the fact that you might be giving him too much credit. Because maybe it had something to do with the fact that the oil had spiked, and maybe it had something to do with the fact that they no longer were fighting in Vietnam, and the fiscal side of it came down. And there is an argument to be made that Volcker is kind of lionized by you monetarists as too much of a hero. And I'm not going to try to make that argument because I know you're going to not want any part of that. But that is just something to keep in mind when you're thinking about Paul Volcker.
All right. Anyway, this week in history, August 6, 1979. It's for all of our younger investors that have not studied some monetary history. Going back to the 70s was, and it's funny because we spend a lot of time talking about the Great Depression and all of the devastating things of deflation and that. But understanding the 1970s, I think, is important because it gives you the other side of the coin, how the markets behave in a inflationary period, especially when inflation is running north of 4%, right?
Right.
All right.
Anyways, thanks for that, Patrick. It's great to hear your This Week in Market History.